Excellent. Good morning. I'm just getting distracted because Layla says she's on Pacific time, so it's 8 a.m. in the morning. It's 11 a.m. here on the East Coast. Good morning, America and the world, as well as California, because you're still part of the world. My name is Samson Williams. I'm the president of the Crowdfunding Professional Association, and today we have Professor George Pullen. He's a senior economist over at Milky Way. I'll let him introduce himself in thorough. Today's topic in today's webinar are valuations, and because everyone in the startup world are always trying to figure out, how do I calculate my valuation? What does that mean to me? I do want to throw out a spoiler alert. George had set up this beautiful, marvelous spreadsheet, and he's like, oh, this is going to be amazing. And then the world decided to pivot. And when the world decided to pivot, because I often tell people that the universe is illiterate, and so life doesn't read your well laid out plans. And so he's going to hit us with what that means since the world has pivoted, particularly for startup valuations, since the Crowdfunding Professional Association planned this webinar way back in January. How has the world changed? We're going to get into that. We're going to get into what that means for your valuation. But first, George has to give us a disclaimer. Shoot, George.
Well, good morning, everyone. Thanks for joining us. I will start with my disclaimer. So my name is George Pullen. I'm here today. You can call me George, you can call me Professor Pullen, either one works. I'm here today in my personal capacity. I do wear another hat where I am a senior economist for the CFTC, which is the Commodities Future Trade Commission. In that capacity, I do a lot of work with commodities, derivatives, option market swaps, etc. That is not my capacity today, however, so I wanted to make sure that everyone's clear that I'm only here as a teacher for you to help you increase your knowledge and your education around valuations and how that can relate to your successful crowdfunding and successful plans for your business. Nothing I say today is going to reflect the views of the government, the CFTC, any of my officials, or anyone appointed or soon to be appointed over there at the CFTC. So thanks. That's the disclaimer.
Awesome. George's government stuff, he's a senior economist for them as well. So if you're uncertain about the market, just blame him. But on that note, George, traditionally, you're a startup. I've got my Golden Girls cup here. I make Golden Girls cups. Walk me through how traditionally I sell 100,000 units of these. They cost me, let's say, $1 to produce. I sell them for $10. I've been in business 1 year. What's my valuation?
Sure. So if you've got 100,000 Golden Girl cups and you sold each one for $10, well, congratulations. You just made $1 million, and you're really happy about that for your small business. And you had to pay, of course, to make those cups. So that other 100,000 went out the door. So you're left with 900,000. You had to pay some taxes and everything else along the way. So you have to figure that in. You probably had some other costs of doing business. So also subtract those out. So right now you're a 1-year-old company. You probably have somewhere in the neighborhood of about $700,000 to $800,000 in sales. If that is you, if that's your business, then what you're going to do is look at your sales and you're going to compare those against your forecasted future sales. So was it just a big Betty White moment, right? And everyone wanted their Golden Girls cups. We should probably go with another example, but if that's the case, maybe this was a period where you sold more than expected. And so your forecasts need to be reasonable for the next few years. And then what we would do is we'd go through a discounting process, most classically, a discounting process looking at your expected sales for years 2, 3, 4, and 5. Now, this is a very classic way to do business evaluations. But before we get too much into the Golden Girls cups, I think the very first thing I want people to remember is that as business owners, as people looking at investment crowdfunding, you're right now, as you educate yourself on business valuations, it's one of the hardest things that finance people do. And it's certainly one of the hardest things that non-finance people do, because your business is your business. Figuring out a business evaluation, that's not your business, right? So there's a reason, and this isn't hyperbole, there's a reason that CPAs and MBAs and CFAs and GARPs and forecasters, consultants, and bankers, they charge so much for their services when it comes to business valuation. So my goal for you is to give you the tools that you need to develop your own business valuation and to make sure that it's held on by a few key principles. The first and foremost of those is going to be your reasonability test. You're going to make sure that everything that you're applying to your business valuation can pass that reasonability test. That's the most important thing I want you to leave with. I'm not trying to help anyone here be a Excel billionaire. That's a term that that's a term that Samson and I throw around a bunch. That's a term, unfortunately, that maybe needs to exist more in the marketplace for people to have a better sense of reasonability and realistic expectations. But if you have a good product or service and you're already selling that good product or service, we can definitely help you with that. If you do not currently have a good product or service, the reasonability test will still apply, and we'll get into how we can do that as we move forward today.
So I just want to recap, because I see Cherie and some other folks have logged on. And again, this is just for your educational knowledge. Traditionally, you look at your production costs, you look at your taxes, you look at your sales, you look at your forecasted future sales. So we started off this analogy saying, I've got my Golden Girls. Betty White is the best Golden Girl, by the way. I've got my Golden Girl cups and I'm selling them. So George, I do want to go back to your forecasted future sales. How do you actually forecast your future sales? Again, we're in the model of, we have a good product or service, we're actually selling them. We're not talking about pre-revenue, pre-idea businesses. How does your future forecast work? What are the key elements to building that?
So if you're building your futures forecast, the first thing that you're going to want to do is have a good handle on your historical performance. So in this example, we have the coffee cup company who's only been in business for 1 year. If your company's been in business for 2 or 3 years, you can look at the growth that you've achieved over those previous 2 or 3 years and forecast them forward in the next 2 or 3 years. So say that you've sold 10 or 15% more cups in year 2 than in year 1, and again, another 10 or 15% increase in year 3. That's a reasonable way to forecast out. That's the first one, is understanding your own historicals and comparing them and then projecting them onto the future. The other way you can do it is by using comparables. Know how much your market is growing and or your competitors are growing. Now, if you are participating in a market that has publicly listed companies, this becomes a much easier exercise. You can look to see how their earnings, how their sales have increased, and then you can use those as proxies for your own. So if they've seen the price of their goods increase by 7 or 8%, or they've seen their sales increase by 10 or 12%, you could also make reasonable assumptions that being part of that same market, you can capture that as effectively, perhaps less effectively, or more effectively. But again, your story has to be reasonable and your forecast the same way. So that's 2 good methods. One is looking at comparables, and the other is looking at your own historicals.
So I have a question here in the chat. It says, suppose you don't have any competitors.
Okay, that's a good question. I would probably argue that you do, but I don't know your specific business, so maybe you don't. If you don't have competitors, though, you still participate in a part of a market, right? So think about the S&P 500, even the Wilshire 2000. There are many sub-indexes and subcategories for both of those broad-based baskets. If you look out into those broad-based baskets, there is probably an existing company doing something similar, maybe not the same, maybe not competitor, something similar. Let's go with an example. If you are currently, I love this one because their advertisements are all over my YouTube for some reason. If you're selling mushroom-based coffee, right? You could say, I have no competitors. I'm the only person out there selling mushroom coffee. And I would say, well, you do have competitors because people have to switch, right? So there's a comparable good, which is regular coffee. And then, of course, coffee has a substitute good, which is tea. And so keep in mind that it might be a bit more of a stretch to find what your competition looks like or where a comparable is. But I would challenge most business owners that you do have someone who, even though they might be in your exact swim lane, they're still in your ocean. And so you can find their numbers and then use those numbers for your own forecast. Because again, we want to make sure that we're presenting reasonable valuations, that we're demonstrating that we have thought through our our business and its likely projections, because, and this is different than the way folks raise money outside of crowdfunding, is you're trying to engage with your customers and your crowd to become investors, or as Samson likes to say, investomers, right? These are people who are one part customer, one part investor. So along the way, you're also going to try to sell them your good product or service, and then hopefully get them interested in your crowdfunding, right? So where they come for the crowdfunding and they stay for the good product or service, or vice versa. It's something that works well together, but that means that your relationship with them is deeper than just someone you're going to pick up off of your E-Trade account or whatever you prefer. You're going to be having a relationship with these people, and so your reasonable evaluation is also a testament to the type of long-term relationship that you like to have with your investor.
I just want to point out, and I'm going to steal this from Layla because she just dropped it in the chat. She says the answer we give to clients who struggle to find clear competitors for analysis is find a business that is trying to provide a similar experience, solve a similar pain point using a different product or service. I think that's a really good point. Often startups and entrepreneurs and founders, when they say, oh, we have no competitors, if you're talking to an experienced VC who's probably seen, no joke, a few thousand deals, particularly if you go to a VC who caters to a specific industry or vertical. When you're 1 in a million on a planet of 7 billion, means there's 7,000 doppelgangers, clones of yourself. Someone has had this idea, and this, particularly if it's a very sophisticated VC, or if you're catering to a specific affinity group, someone has seen this type of good product or service before, and they can say, hey, you're approaching the same problem from a different angle, but here's one of the people who, they're not your competitor, but you still, to George's point, you'd have to displace them, in which case they are actually your competitor. So again, that goes into, again, how this is just the basics for establishing your valuation. We talked about future forecast sales. We talked about comparables in the markets and among competitors. George, you said 2 things, which if you could give our listeners 30 seconds on each. S&P 500, Wilshire. Why are those important?
Sure. So these are large indexes that contain numerous publicly traded companies. The S&P, of course, 500, and the Wilshire, the frontline index is 2,000. There's also a 5,000, but these are companies that are publicly facing, so they have their paperwork available to anyone who wants to search for them. They can go to the SEC's website. They can search for their 10K filings. And they can find out much, all the information you'd ever want, actually, about any of these companies. What that helps you with is that between these 500 very large companies and these 5,000 slightly smaller companies, there's going to be a business in there that you can pull comparables from. And again, like the commenter said, and this is a good point, they might be solving a similar problem in a different way. That's a great comparable. Another red flag for your evaluation, and this makes me think about this because of what Samson just mentioned about how when people say they have no competitors sometimes, and that's a red flag to folks, is when people go with this expressions which are very overplayed these days, where they say, we're the next Uber or next Facebook, next Amazon, next Apple, and then they try to use those types of multipliers. Your business is your business, Apple's not your business. And so when you're picking a proxy variable, and when you're picking up a business to pull data from to use in a reasonable way for your own forecasts, try to stay away from FANGs would be my best tip. It's going to raise more questions than it's probably worth. The other thing that's important to remember is when you're looking at the comparison method, or even the discounted cash flow method, which we'll get into here next, the price to earning ratios for many of the companies that make up the S&P 500 and the Wilshire have price to earnings ratios that are anywhere from 15 to 25% or more. Some of them don't even have earnings, or more. A smaller enterprises multiple is generally in the range of 2 to 5. I have folks argue it from 5 to 10. I'm always willing to listen to why. But remember, your multiple is not the same as the market-facing multiple. There's a lot of great financial literature and economic reasons for that. This isn't a finance class, so we're not going to get into that. But just keep in mind that your investors don't anticipate you having multiples that are 15 to 25 or more, much like they'd experience with an investment into a publicly facing company.
George, you've highlighted some things. I see a question here in the chat. Is there a simple rule of thumb for quickly estimating your valuation? You said a lot of stuff, right? But is there a simple rule of thumb for quickly estimating your valuation? Napkin math, otherwise.
Napkin math. So the first thing we're going to do is we're going to say, do you have sales or do you not have sales? Okay.
We're selling cups.
Yep. So if you have sales, you don't have sales. If you have sales, tell me what your sales forecast is over the next 5-year period. And then we're going to do a discounted cash flow based on that. So we're going to say, I think I'm going to sell this many cups over this period of time, this many in each year. And then I'm going to do a discount of each of those cash flows over that 5-year period. And that will give you a napkin number for your enterprise.
So
and when we talk about discount, this is important, discount rate, because world events matter. So, so your discount rate's important. Discount rates typically, for a long time, have been about 8%. And so when you discount 8%, so think about your 5th year, right? So year 1, you made the $1 million, right? Year 2, you made 1.1, et cetera, right? If you think about your discount in year 5, if it was an 8% discount rate, a very normal discount rate, your $1 million that you're earning that year is only really worth a little over 600,000. Okay, so in your calculator, your Excel, you would take 1.08 and you'd raise it to 5, right? And that gives you what your discount is for the year 5. And you do the same thing for year 4, 3, 2, and 1, except that instead of raising to 5, you're raising to 4, 3, and 2. So my point here is that your future cash flows are worth less, and that's why it's called a discount cash flow. So again, 5-year period, that 5th year is worth less. That's 8%, okay? Let's take a step back and talk about world events. Right now, inflation is being talked about everywhere. I'm not going to make large statements about what I think about inflation. Wherever you think about inflation, everyone has their own opinion. Take that 8%, would have the normal inflation considerations, and let's just, for the sake of argument, think that your inflation expectations are now about 4% higher. That'd be a very small increased expectation since headline inflation has been 7 or 8% the last few quarters, but we'll just say yours is 4. Instead of an 8% discount rate, you now have to go to a 12% discount rate. Okay, if you go to a 12% discount rate, that's going to impact your evaluation. Let's also say, in addition to inflation expectations, let's say that business health and business growth expectations are also a little bit lower. So we add another 4%. Okay, so now your discount rate instead of 8%, right, typical market, is 16%. If your discount rate is 16%, so now this is 1.16 to the power of 5. If your discount rate is now 16%, that means that when you go out 5 years, you're looking at roughly you're looking at roughly half. So that $1 million that you'd hope to make in year 5 is now actually, on a discount basis, only worth about $500,000. Things get even more screwy, and I don't want to scare people, but again, let's be reasonable. Things even more screwy if you start having inflation expectations or risk expectations that are even higher. So again, 8%, you add some extra inflation and risk expectations, now you're 16% discount. Now you say, okay, I think inflation might be even higher. Okay, or I think my risk might be even higher. So now your discount rate becomes 24%. Okay, so we 8% example, remember classic 16% example, 24% example, turbulent time. If your discount rate is 24%, that means that $1 million that you're forecasting out for year 5 on a discount cash flow basis is really only worth about 200 grand.
So if in year 5 it's only worth 200 grand, how much does that make my business worth today?
Well, your business is worth $1 million for year 1. right, that you've forecasted out. Your two ends up, again, this is the 24%, the extreme example. Your two is worth closer to 750. So that's 1 million plus 750, that's 1.75. Year three, let's call it 5, right? So 2.25. Year four, you're getting closer to 300 now, and year five, 200. So altogether there, your business was worth 3 plus 5, so 3.5.
3.5, based upon $1 million in sales today. Because first off, for anyone listening, don't be intimidated by George's sorcery. He's an economist. He said a lot of words that you might not understand, because I hear on the street people say, oh, the easiest way to determine your value is a multiple of 3 or 5 or 10, depending on your industry. And so that is the simplest way of saying, okay, I made X times 3, and that's what my company is worth. But then if you peel back the layers of that onion, there's a lot that goes into, if someone sits down to actually look at your books, look at your cash flows, look at your discounted rate process for the next 2, 3, 4, 5, accounting for some of the turbulence in the market in the world, your business where you're thinking, hey, I made $1 million, I'm worth 10x. It's really, you might have made $1 million, but once we look at your discounted cash process, you're only worth 3.5. Is that accurate?
It is, and that's why it's important, again, for your very first step, regardless of what method you go with, is to research comparables. So, for example, and I'm not saying that your business is a restaurant business, but let's just use restaurants. If you're in the restaurant business, then you should know that McDonald's franchises, how much they cost, not because you're selling French fries or toys, but because that lets you know that they're about $2 million and they earn their owners about $150,000 a year. Or maybe you're in a business that makes widgets, right? So you have to do your research and know that, okay, businesses that have 5 CNC machines, CNC machines are they're actually really cool. They're really expensive pieces of equipment. They allow you to make parts for precision and automotive purposes, precision machinery and automotive purposes. But you would know that if you have 5 CNC machines, it's going to earn you about $250,000 a year. And if somebody wanted to buy that business with all the CNC machines, they're going to pay about $5 million, right? So I don't know if you're in the CNC business, machining business. I don't know if you're in the restaurant business, but when you do your research on your comparable industry, you should know, okay, well, McDonald's franchise, that's $2 million, it makes them $150,000 a year. CNC machines, 5 of them, that's $250,000 a year. Those sell for $5 million. Like, these are things you should know, but again, for your specific business, because as you do that research, you're going to be able to know the other parts of this equation. You're going to be able to know, okay, for those businesses, it looks like I see folks using a 8x, right, or a 10x. Or for these other businesses, it looks like everyone using a 2 to 5x on sales. Okay, that's fantastic. But again, once you know where you're fitting in, you will have these comparables and it'll be much more valuable to you. The next part about this is discounted cash flows I just went over. You can get as creative as you want with your discounted cash flows, just like you can with your comparables. But the idea is, and I think a best approach is, to give yourself a range, right? Think of it as my first rule is, of course, reasonability, know your comps. My second rule is bumpers, right? So know both your low end value and your high end value. Your business is an average. You're not, none of you would be average if you're taking the time to learn about better ways to do your evaluation, better ways to raise capital to make your businesses successful. So we're not just going to take the low and high and take something in between, but you should have a good idea about these bumpers so that you know what the potential value of your business is.
I love it, George. I feel like my brain is bombarded and I talk to you on a regular basis about this, but you just dropped some new information on me. So we're going to pause very briefly, just because I think the summary from that is, if you're trying to calculate your valuation, you should be thinking 3.5 to 5x. However, you need to go out and find your comparables and say, this is why it's 3.5. This is why it might be 10 when we're looking at that multiple. And again, you just summarized it so eloquently in your bumpers. Who's at the bottom? Who's at the high?
Yep.
So if you're in a startup world, you can actually get a CPA, get a finance person to help you do through this process, because whatever your business is, that's your business. Learning the minutia and the details of your valuation isn't necessarily your business. But I understand now better why investors, they struggle so much with some of the valuations. And I want to switch the conversation a little bit, because recent events, Putin invaded Ukraine. It's changed, it's pivoted the world. The world was like a lot of uncertainty. We had a lot of cash flow into the economy in the last 24 months, but now we've seen it. And George has a site he wants to share from Woody Neese about the amount of investments flowing into crowdfunding and how that's impacting valuation. So George, now that we've switched paradigms and we're coming out of this free flow of money, it's not Gensler, it's Jerome Powell. A couple days ago, he said, hey, we're going up these basis points. So tell us, George, share with us some insights on, now that we're in a new paradigm and we have a new paradigm, free money is coming to an end, basis points are going up. One, explain to us what basis points are, and two, why that matters from an investor perspective about valuations. Go for it.
Sure. So these are timely current topics. So let's cover them. So the first one is when the Federal Reserve sets the federal funds rate. What that does is it affects the rate at which banks can borrow from the Fed and from each other. Okay, think of it that way, as the rate that the business of banks operates at. It has been very close to zero for a very long time, which has meant that borrowing money was relatively cheap, particularly by historical terms. Anyone with a few gray hairs would know that mortgage rates between 8 and 10% were quite normal if they got their first home back in the 90s or early 2000s. We've seen other periods of time where the rate to borrow, and again, we're just using mortgage lending as an example, was as high as 15 to 20%. So keep this in mind, that rates right now are near historical lows, and there's probably been a million advertisements or flyers that come to your house about that because everyone wants to refinance. When this period ends, and it is ending right now by all indications, what that means is that the Fed is raising the rate at which these banks borrow. When they raise the rate that they can borrow at, that's going to affect the rate that you can borrow at. Now, you might be saying, well, I'm not looking to borrow, I'm looking to raise capital. Remember, when you're raising capital, there's three ways to do it. You're either borrowing it, you're getting investors, or you're selling. This is the best one, right? You're selling, that way you didn't have to borrow it from anyone, right? Or you didn't have to get from an investor. But anyway, those are the three ways that you're raising capital. But these three ways have to have comparable rates, right? So I'm either, as a substitute, this is the coffee and tea or the mushroom coffee example, I'm either borrowing or I'm getting investment dollars. If the rate at which people borrowing now, it can be expected to go up based on the federal announcements of 6 rate increases, they're saying each one could be anywhere from 1/4 to 0.5%. Well, let's just call that a 2 to 2.5% raise. And that's what's being advertised, right? So if you know the rate to borrow is going to go up by 2.5%, that means the return that investors will expect also must go up by that same 2.5%. But remember, investors already had more baked in. When you borrow, there's an expectation that if something goes wrong, that there are assets that are securing it. For an investor, oftentimes there are not. Okay, so their rate was already higher. This is called there's a differential here. It's called differential. So when the rate for borrowing goes up, the cost for borrowing goes up. That means the rate that investors expect also must go up in kind. So money just got more expensive. So that's why before, when we were talking about you might do these calculations using an 8% discount, that's why I'm having people think about whether it might be more appropriate to have their discounts be 16% or even higher than that.
Mm-hmm. No, it's very interesting because it's all about the cost of funds for investors, not just the cost of funds for entrepreneurs and startups, because also we saw some crazy valuations. Can you tell us why did not necessarily why we saw such crazy valuations from 2020 to 2020 to January 2022, but what does this mean now that the cost of funds have gone up? What does this mean if you're a startup and you're going to jump on some buzzword to raise money? What could that mean for your business and your valuation of your business?
Right. So previously, let's say, and we'll, I'll vaguely reference to Woody's numbers. I'm not going to cite them precisely, but if I vaguely reference to Woody's numbers, we saw evaluations for crowdfunding deals hover north of that $10 million mark. I believe it was pretty close to 12 or even 15 toward the end of the cycle. And so valuations that were typically in that 12 to $15 million range meant that when people were raising, let's just make the math easier. If you were raising 1.5 million, again, of course, the new limit being 5 million. If you were raising 1.5 million on a $15 million valuation, that means you were looking to have investors purchase 10% of your company. And they're purchasing that 10% of their company because they hope, and you've convinced them, this $15 million company, which they all now share 10% of, this $15 million company is going to go to a $150 million company, right? And so we all get a nice 10x. We're all super excited, right? That's what the investors want, right? And that's what you want too. You want your company to be super successful because hopefully even after the dilution of selling off some of your shares, you still own the majority of it. Now, that's probably a whole nother webinar about dilution. There's all kinds of ways dilution can get you. That's just the easiest one. But no, I mentioned this because expectations are now that your company through the course of time will not be worth that 150 million. And the way inflation gets baked in, you can either say it's not worth 150 million, or because it's inflated future dollars, it's worth less than 150 million. It's not worth fighting about. Just think of it mentally as being less than 150 million. That means your company now is going to be having that, everything else exactly the same. The growth prospect is now the company's 100 million. Well, now I'm not investing in something that has me convinced that this could be a 10x. Now I'm investing in something that looks a lot more like a 7 or 8x. And so I'm going to want to fund at a different rate. So my expectations have changed. The market's expectations are changed. And so an evaluation of 15 million doesn't make sense anymore, right? If I still want this price as a 10x, well, that means your evaluation has to go from 15 down to 10 million. You just lost $5 million in your evaluation. But that's happening right now, right? So the napkin math for a long time had been 10 million. And before that, it had been 5 for a really long time. I'm not saying that we're going back to 5, but the napkin math for many firms had been 10 million. And Simpson and I actually talked about this, I think, on another webinar, where now your pitch deck and your pitch deck and your video and your idea is worth 15, or even we start talking about seeing 20 and $25 million for pitch decks and ideas. That's gone. That's not the market now, right? We very quickly come back to something that's closer to a $10 million average. I think as Woody puts out his future numbers, you'll see that reflected in the filings, where the averages will come back down to that $10 million range. I'm not saying we're going all the way back down to 5, but people should be aware that these numbers are coming down, which means your evaluations have to come down accordingly too.
Mm-hmm. So again, you're listening to Samson Williams on the Crowdfunding Professional Association. For those folks who listen to this on the webinar, you're listening to also George Pullen, Chief Economist from Milky Way, as he takes a sip of his coffee. George, we covered quite a bit because, one, for your valuations, the first thing you started off with was you got to know your production costs. How much does it cost to make this coffee mug? And so I want to circle back because we started at production costs for your valuations. Fast forward now that we see the Fed raise the rate for funds, so cash got a little bit more, the cost of funds got a little bit more expensive for investors. And so they're going to try to get the maximum amount of dollar value for their dollar from startups. So that causes the valuation of startups to lower, to go from 25, 15, closer to 10, not closer to 5, but cross your fingers on that. And so I do want to ask you because it's never super simple to come up with your company's valuation. If you just want to do the simple times 3, a multiple of 3, multiple of 5, you can maybe a multiple of 10, depending on your industry and again, your comparables. But I want to ask you a question about, because when we talk about this coffee cup or whatever your business is in production cost, I'm looking at gas, I'm looking at crude oil, I'm looking at liquid natural gas. I'm assuming this is also going to increase your production cost pretty much regardless of your industry, particularly if you have a product that needs to be delivered. Is inflation also going to drive up operational costs for startups?
Yeah, so this is a good point too, right? So when you think about what are the input costs of your business, keep an eye out for what I would say, top drivers are, but don't fail to pay attention to some of the ones that used to be inexpensive, which might not be inexpensive anymore. Let's say electricity, for example. Let's say that you're running these hypothetical CNC machines I referenced earlier. CNC machines suck down a lot of electricity. So if you believe that electricity costs are going up because natural gas costs are going up because natural gas is what's put into LNG, and LNG is what's shipped around the world to displace various tyrants, natural gas, then right, electricity costs are going up. And if electricity is a big part of the cost structure of your business, you need to take that into account and make a reasonable forecast about what that could mean for your business if suddenly electricity costs are 10 or even 20% more expensive. Or it might be the case that electricity is not one of your top costs, or gasoline is not one of your top business costs. Also keep an eye out for the way those might change and become an unexpected top cost or an unexpected top 5 cost for your business. This is just, again, business awareness around how these variables will affect your profitability on your cost of goods sold. Something else I want to make sure we cover, it's related here, but it has to go back to when we talk about bumpers, and we've had quite a bit of conversation around your assets and your business's assets. And some people might say, well, my business doesn't have a lot of physical assets, office space or supplies or receivables or whatever the case may be. Also think about the rest of your assets. So these might be assets such as financial backing. So these might be letters of intent or MOUs, so LOIs or MOUs, memorandums of understanding, between other businesses in your space or in a space that you plan to sell to, right? Those are worth, those have tangible value, right? If someone has a letter of intent to purchase your good product or service as soon as X happens, or you have a memorandum of understanding between you and another business that will complement both of you, there's a value to those. It's not as specific and as easy to account for as my office space or my CNC machine or my supplies or my receivables, but don't forget about those. Also think about things like, again, a little bit harder, but maybe vehicles or equipment that you've put in your name now, but should probably be put into your business's name. Those also add assets and add value to your business. And again, this is the bumper, so we're looking at like getting the low end of your business. Also think about your network value in the industry. I encourage people to think about this because remember, I'm stealing this from Samson, but crowdfunding works best with the crowd. And so I know it's super revolutionary to think about that, but the crowdfunding works better with the crowd. Something that Woody's statistics point to too is that, and I believe, hold on, let's see if I get it right. Yep, here it is. Somewhere around, yep, here we go. Somewhere between 5 and a little over 5% of issuers who went out to the market end up not raising a single cent. Is that because they had an evaluation that was too high? Maybe. Or is that because they hadn't tapped into their networks and realized that they need a crowd to sell to? So part of your business's value is also a reflection of your network value within your industry, within your business vertical. Also, business verticals and industries, think about trademarks and IP that you've generated and the patents off of those. That's also assets for your business. People are going to want to know that you have copyrights, trademarks, intellectual property, et cetera, and that it is being protected. it's not always enough just to have the idea. Your investors are also going to know that these things have gone through the necessary legal protections so that we know that they are both owned by and afforded for the use for the business. So bottom line on this point is you need to take a full inventory of all of these other assets to make sure that you calculate your bumpers correctly. And again, this is part of your taking your full inventory. And the reason I thought about it is because we're talking about rising costs, like for electricity and potentially transportation, so gasoline costs. This is a full accounting, right? So know what your cost structures look like, and then go through the exercise of playing with some of these variables and saying, okay, well, what if my electricity bills do go up by 20%? Or what if my cost of rent for my storefront goes up 25%? What if my lease goes up? Well, play with these numbers and see what impacts they have on your cost of goods sold, because that'll have a direct impact on your valuations when we're looking at those previously mentioned multipliers.
George, I need a pause. I need to switch from coffee to tea because you just dumped a lot on my brain. Because most entrepreneurs, their business valuations and peeling back the onions isn't their business. So I'm going to give a 2-minute warning to the audience. If you have a question or comment for George, just let us know. Drop it in the chat. We're going to summarize this quickly because traditionally, when you're looking at your valuation, looking at your production costs, how much taxes you may or may owe after you do sales, then you need to look at your sales. Then you need to, what are your future forecasted sales? Then your discounting cash process over a 2, 3, 4, 5 year process. You also have to be sure about your reasonability test, meaning compared to your comparables and your bumpers, your valuation is reasonable, particularly given that the era of free money is coming to an end as the Federal Reserve bumps up the interest rates for borrowing funds, not only from banks, but also for VCs. Because as George says, George, what are your 3 things where selling is the best one? Give me that again.
Oh, yes. Back to that. So you have 3 ways to raise money for a business. You can borrow, right? So that's going to the bank, asking for loans. You have investors, and you have sales. 3 ways.
Yeah. So you're going to see, as startups, as founders, you're going to see your cost of funds go up a little bit. At the same time, inflation may also be increasing your basic operational cost, which is going to impact your profitability. And then there's some other reasons why your overall value might come down to reasonable expectations. Because in the past, when I say the past, I mean in the last 24 months, we've seen some crazy valuations based on just, Excel billionaires saying I'm worth $1 billion. I think that because the cost of funds is going up a bit, we'll have some adjustment in the markets for that. So last but not least, grow your community. As the Crowdfunding Association, I believe crowdfunding is, your customers have more money than investors, because your customers are what makes your business profitable, not your investors. And so continue to grow your community, because you can't flip a switch, put your deal up on a platform and just automatically get funding. George shared a stat about 5% of people who put deals on the platforms did not raise any money at all, because you still have to do a lot of legwork. So I just want to reinforce that. So I'm going to pause, ask if there's any questions from the audience. And if there's not any other questions, I'm going to give George the last 60 seconds to wrap us up. So George, I don't see any questions coming in. What's the one thing you want everyone to take away when they're thinking about their valuations? Go for it.
When they're thinking about their evaluations, I know it seems like a daunting process, right? And so when you're thinking about it, I think make sure that you understand that you want to be reasonable, that you don't want to set off any red flags for your investors, because like we talked about with any good campaign, hopefully that your investors are also a portion of your customers. You want to treat them fairly. You want to make sure you avoid any red flags. You 100% want to avoid any puffery. And so be reasonable. Make sure that you understand both the high and the low based on your comparables. Perform a reasonable discounted cash flow to make sure you understand also how that looks next to your comparables. Something we hadn't hit on, and I didn't hear someone ask, but it was a question I was expecting, which is how do we account for your own salaries? Make sure when you're looking at your business valuation that you're also thinking about the income that the business produces. So that could very well be your salary or the salary of a few other key people or strategic individuals. You need to break this down further. But again, keep that in mind as something else. And last but not least is the growth projections. So again, go on your track record, go on a historical track record based on similarly positioned businesses or businesses that are solving similar problems. I think one of the people in the chat, I think Mr. Roberts had mentioned that. That's a very good way to look at it too. And then, just to really drive this home, two things. One, ultimately the market will determine your price. That's a hard reality, but that is a fact. The market will determine your price. If you set a valuation that's too high, markets will respond by not coming to your deal. Keep in mind that there are many angel groups and the like, which have a requirement that an evaluation is below a certain threshold to even show up and make presentations. I'm not going to pick on any of them in particular, but many of them have those caps I previously mentioned, which to even present to an angel group, you have to have a valuation of below 10 million. So you have to be a startup that doesn't have an evaluation that's 50 or 100 million without any current revenue. And then another point I would say here is be careful of stealth mode. If any of you who are on LinkedIn know this, and by the way, if you're on LinkedIn, by all means, reach out. Happy to network and connect with you. You'll see people who are working, at stealth mode or for stealth and everyone else. If you're not actively engaging with your community and talking about your business, your business will die. Stealth mode's great, especially if you have a fantastic single source DoD contract. Be in stealth mode forever. Don't even tell me about it. I don't care. Tell me you're a volunteer firefighter, right? But if you're in stealth mode and you have a business that needs to see the light of day, start engaging with the community as soon as possible. For resources, I'd point to people just to not to word dump them, but when the thing about evaluations and reporting, the IRS has a myriad of things you can look at, like they have their revenue rulings, rulings. IRS.
Oh, IRS. Continue. No. I know who they are.
Not Hootie.
It's a great book reference. Go on.
Yes. IRS has their revenue rulings, both 59 and 60. You've got your FASB accounting standards, your Code 820 valuations. You've got your FAS 157 evaluation guidelines. I point these three things out to you. I'll put their exact titles in the chat so people have them to look at. But there's also plenty of guardrails out there to help yourselves make a good business valuation. And if anything, use these as educational tools so that if you do end up engaging with lawyers, CPA, business appraisers, professionals, anything like that, that you've already come up with your comparables, just kind of cash flows and your reasonability tests so that you're going in well armed, right? Whether you decide to go it alone or engage with a professional, you've become educated in these respects enough that you have the right sense about how to do a business valuation that'll be beneficial for your crowdfunding endeavors.
Awesome. So thank you all for joining and attending. I'm going to summarize this. You probably want to hire a professional to help you calculate your valuation. There's a lot of details in there. Otherwise, just do the napkin math. Say we're between 3 to 5x. We do have I think this is a question that came in. I think George has time. Is the risk premium for crowdfunded businesses lower than traditional privately funded businesses? Because, as you point out, there's a value in the crowd, i.e. your investors are potential customers and evangelists and are more numerous than institutional investors.
Ooh, I like Vincent's question. Okay, let's pull this apart a little bit to go each step, and we're going to define a couple of terms here, right? So the first part of this is the risk premium for crowd-funded businesses lower? So the first thing I'm going to say is that your risk premium is not lower. So the risk premium is the difference between what I talked about earlier, which is the rate that banks can borrow at, right? So the US government, banks that borrow from each other, they borrow from each other and from the US government at virtually free today. As we talked about, it's going up quite a bit. It might go up as much as 2.5%. That being the case, that's what we talk about as your risk-free rate. I'm sure we could do an entire economics class on that. We don't need to. Just think of that as your risk-free rate. Again, that's the rate that the US government and banks borrow from each other at, okay? Your risk premium that Vincent mentions, your risk premium is what is in addition to that, okay? So a very normal risk premium that you might see associated with bonds, right? This is debt, this is capital, this is debt, this is capital that is being borrowed by larger institutions. That would be another about 4 percentage points of the AAA rated, which is the highest rating, above the risk-free, okay? After that, as you keep going out, you then have your capital that is done through investment vehicles, right? So this would be the issuance of stocks, right? A lot of times that gets out to the 6 and 8% range, okay? Now, keep in mind, it's a nuance, but it's important. As inflation expectations are increasing and as risk expectations are increasing, both of these margins I talked about there, the 4 and the 8, are actually going to also expand. It's because the entire risk curve expands. That's more than you maybe need to know, but just keep in mind that the 4 and the 8 are rules of thumb. It's not a hard and fast. So let's go back. So the risk premium for a crowdfunding business is going to be automatically higher than the risk premium would be on a corporate bond or on a publicly traded stock, right? The risk premium is automatically going to be higher. So the reason this is important to remember, though, and this goes back to the second part of this question, is that because you are funding from your crowd, 100% all the time, you're going to treat your crowd more fairly. And you know that your crowd could go out and expect 4% for investment in certain, bonds from GE or something like that, or 8% with their stock investments, right? And because of that, and because they're your crowd and they're hopefully also your customers, you're going to make sure that what you're returning to them is higher than that. Okay, so, and that's before you get into whether or not you're more risky than a Fortune 500 company. Probably something funny there. I'm going to avoid saying it because they get bailed out. We don't, because we're small, right? We don't get bailed out. But I mentioned that because it comes into the value proposition and the relationship that you have with them. They want the opportunity to participate in your business, 2xing, 5xing, 10xing. So part of that is making sure that you understand that they could already just go out and substitute good coffee for tea into a bond or into a stock for someplace else that's publicly traded. So keep that in mind. So yeah, your risk premium will not actually be lower. It will be higher. But again, you can recoup some of that because remember, you're also selling to them at the same time, right? So they're buying your good product or service at the same time. And that can make it very effective and a great strategy where you're picking up an investor, you're also selling to that same investor, and you're building your crowd at the same time and reinforcing your brand. That's the triangle, right, Samson?
Triangle financing. I love it. I love it. So, oh yes.
Yep, that's right. I like how he said it in 6 words instead of in 5 minutes. So
he said, "We got you. We reward our crowd with higher returns." Vincent did a great job of emotionally translating that out. So thank you all for joining us. You're joining the Crowdfunding Professional Association, and thank you for George for joining us. You can find George on LinkedIn, George S Pullen. He's Chief Economist over at Milky Way Economy. Reach out to him if you have any other additional technical questions. In the meantime, if you're not already a member of the Crowdfunding Professional Association, I strongly encourage you to join. We will continue to roll out these educational seminars, not only on crowdfunding. I think the next one is cost estimating for construction projects who are looking to crowdfund. It's a super important webinar to join us for because due to inflation and the rising interest rates, your cost for your construction businesses is actually going up not 1% or 2%, probably closer to 3 to 6%. So you want to tune in. I think that's April 12th. We'll send out an announcement for everyone. So you can tune into that one as well if you're in the real estate development, property flipping business or vertical. Till then, my final thought is, are there any salaries in stealth mode? And so it's a rhetorical question. We don't have to answer it, but I'm going to echo George's statement. Please, please do not be in stealth mode. If you're in stealth mode, don't talk to me. Be in stealth mode. See how that works? Till then, see you all later. Thanks for joining us. Have a great day. Bye-bye.